Gold extended its losses earlier this week before rebounding after the FOMC meeting on Wednesday. Joining me today, Phil Streible, senior market analyst at RJO Futures. Phil, you called it. Welcome back.
Oh, thanks for having me.
You know, since we spoke last week, gold kept sliding, even below its 200-day moving average. The question now, is the FOMC's decision to keep rates unchanged enough to keep this gold rally going here?
Nah, I don't think so. I think actually gold prices might continue to slide down. I'd be really concerned if we saw a close below 1,300. The dollar index has really been weighing in on gold, and the dollar broke out from a small consolidation range, and it looks like we could target some of those previous highs at 95 on the dollar. If we look, the last time that it was at that level was last November, and gold prices were down at 12.75. So if the dollar continues to rally, I think that's what's going to weigh in on gold.
Phil, also, we are still seeing slightly more short gold future positions in the latest commitment of traders report. You know, 480,000 total shorts versus 450,000 long positions. So are you concerned, you know, you mentioned you talked about it, but could this add to the downward pressure here?
I really think it will, and we saw that unemployment report come out this morning. We've got the unemployment rate at 3.9%. That's the lowest level we've seen in 18 years. That's going to considerably weigh in on the Fed's decision to raise rates at the next go-around. So in June, they should raise rates again. That'll probably be another catalyst to put the pressure on. I think your longer-term trend traders, if you look at the ADX, which measures the strength of the downward trend, it's at 40, which is a considerably strong downward trending market. That bounce that we received when we were down at like 1302, that was just a market reactionary bounce, people buying against some of these key levels, and we have seen the market come back up. We've gone to the 200-day moving average. Right now, we're trading a little bit below it. It's right around 13.14, so I think that adds as a new headwind, but ultimately, I think we're going to move down. The problem is the safe haven demand has completely disappeared out of the market. It seems like North Korea, you know, there's talk they may release three people that they've held for a long time, and it just shows that those geopolitical risks have really come out of the market.
And that's a good point, Phil. Where has the safe haven play gone?
Well, yeah, it's probably moved to the oil market. If you look at the tensions we have in Iran, if they come up and they renegotiate the nuclear agreement, we may see Iran curb some of its exports of oil, and that's driving prices up. I mean, oil's like $69. I think it's going to hit 70 real soon. So, I mean, that's where your safe haven demand's at. If you're going to play gold to the long side, I think you really got to take the dollar index aspect out of it. So you'd want to be like long dollar futures and gold at the same time. I think that would hedge you a little bit on the rising dollar.
Good thoughts. Phil Streible, thank you so much for joining us.
And thanks for having me.
And thank you for watching. We'll be back next week.